Why interest rate cuts will not save you on your next mortgage renewal. I'm going to give you a quick macro update with all the data I'm seeing right now to explain to you what's actually happening. But yes, sentiment is getting better, but we're not getting back to those pandemic rates that we saw years ago. And I still think there's a very good chance a recession is coming. So make sure you stay tuned as I explain all of this. And after watching this video and viewing some of my data points and kind of like where the landscape is and where rates may be or may not be going, and if you are concerned about your renewal, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zen, and if you're enjoying the content I'm putting out there, do me a favor and like and subscribe. Now, things have changed a lot since December, where, in the interest rate projection world, it was more rosy, right? So if you look at this chart over here, back in December, things were looking, pretty with 6 potential rate cuts by the Bank of Canada. However, things are now less rosy, and we're only expecting 3 cuts by the Bank of Canada. So if you're coming up for a mortgage renewal, whether you're negative amortizing or coming from fixed, and hoping that rates will be down by the time you renew, this is not the news you're looking for. It's probably going to be higher than what you're coming from. So if you compare our rate increase to the rest of the rate increase historically we've had in Canada, basically since the post-pandemic increase that we have, it blows every single rate increase we've ever had out of the water. It's so big and so long. There's a joke somewhere there. It's currently second longest at the moment, that it should have broken something, but we haven't. And people are still talking about a soft landing, right? So if you note this article I put up here, it was from last year in Q4. Now, we've had some ridiculous hot inflation prints from the US where inflation is higher than what most people expected. Job growth is higher. They actually have a strong economy where GDP things are looking good. And, it's changed a lot of the outlook now because of those things. And this is why the 5-year bond market, which again is the prediction of kind of where the Bank of Canada plans to make changes on the rates and also determines the direction of the fixed rate mortgages, it spiked up a little bit in the last bit. And when you zoom into this, you can see that the minute the date that US inflation came out hot, it spiked it because good news is bad news now. And this is why I think anyone that truly understands this stuff knows that it's hard to predict, right? And you can even see over here that not a single one of these probabilities in the short-term interest rate movement is over 50% because nobody knows, right? And this is what I've been saying a lot in the last little bit. Volatility is the name of the game right now. This is why when you look at this chart, essentially every month the projection keeps changing. You see it goes up, down. So this is why I haven't completely turned very bullish quite just yet in the Toronto real estate market, despite we're getting a lot of multiple offers and they're coming back, and I'm seeing strength in the data with the months of inventory coming down. It's because I see all of this data and I still see recessionary stuff that's looming over our heads right now. If you look at the latest layoffs in Canada, these are some big companies we're talking about laying a big amount of their kind of employees off. We're talking Bell, BlackBerry, I don't know if it's big, but Chorus, the CPA, Enbridge, Google, Staples. These are not small companies, right? Now, if you look at this chart, it shows you the number of months it took a recession to happen when the yield curve inverts. So this is basically when the shorter term rates are higher than the longer term rates, which is generally a sign of recession. I think we talked about this in the last 18 months. And the average time between the yield curve inverting and a recession actually hitting in the last 50 years, so 5 decades, is 18 months. The Canadian yield curve only inverted 14 months ago in November of 2022, not on the first rate hike in Feb 2022. So we're still well below the average for the lag of the interest rate and the yield curve inversion to take effect and hit a recession, especially with all these layoffs in sight. My biggest concern is that if we get big time rate cuts that everyone's hoping for, it's because we're in a recession where we lost way more jobs, which traditionally means real estate prices go down because people hold off big purchases if they got laid off, right? So at that point, bad news isn't good news anymore. Bad news is bad news. And this is kind of my concern. But let's entertain the idea of a soft landing, because it very much could be possible if companies make it out with minimal job cuts and we get some kind of economic growth. So let's assume, based on their projections, that the first rate cut is in June, right, as what we talked about earlier. This means that we have 5 potential dates for rate cuts for the rest of the year. The current projection is that we're going to get 3 rate cuts, but we're no longer able to do 6 because we have 5 dates left, which means the previous projection of 6 rate cuts is not happening, unless we get a bigger than 0.25 or 25 basis point cut, which I would say probably means that we hit a pretty big recession. So if you look at the rate cut projection chart again, for us to get back to the pandemic rates for a lot of these mortgage renewals, FYI, it's that red line that's literally off the charts. We need an additional 175 basis points or 7 25 basis point rate cuts in addition to the 3 we're projecting to get this year. Can we get there? Yeah. Do we have time? Yeah. But do I honestly think we're going to get there? No. Right? Again, we're in a decade of volatility. And this is why I said in the beginning of the video, if you're waiting for rate cuts to save you for your renewal, I don't think it's going to happen. So you need to be prepared for it, unless we get a massive deep recession, which again, you may need to prepare for that as well. And this is exactly where the trouble lies. Remember those pesky negative amortization mortgages, the ones that are underwater? Well, they made up 45% of the renewals last year in 2023, and they have been subjected to payment increases. We survived that hurdle, which is wonderful. But there's still another 55%, more than half of the renewals that will be happening in the next 24 to 36 months. And these have higher mortgages and they got with lower rates, which means that payment shock is going to be bigger. And that's that green dotted line right here. And there's still more than half of them that haven't seen a payment shock. This is what I'm kind of cautiously looking out for. And if you fall into that category, I highly doubt we'll have a rate with a 2 in front of it by the time your renewal happens. So make sure you plan accordingly, whether you speed it up, make a lump sum payment. You can do all of that, but just try to survive. Now, I'm optimistic that most families with homes can survive this, but I know that there are going to be some out there who cannot or cannot because they're over leveraged. So you got to watch out. And finally, if you're wondering why the market is still so strong, despite all the things I just told you, it's because the fixed rates are cheaper than the variables right now. And while a lot of the homeowners right now that may be underwater or have a negative amortization or coming out of a low fixed rate in the next little bit, the existing cohort of buyers, the demand, they're able to use the 5% fixed rate that we see right now. And currently there's a spread of 1% or 100 basis points between the variable and the fixed. And this is why the market is active right now. The current pool of buyers has a locked-in fixed rate with a 5 in front of it, while the sellers are potentially running out of time with their higher variables or very low fixed rates when they're renewing. So it'll be a battle of the supply versus demand, and combined with the motivation of both parties. And that's kind of the name of the game right now that no one can realistically predict. The spread between the fixed and the variable is about like 4 rate cuts right now. And will we see that by, the second half of like 2024? The current projections say no, but I wouldn't say that's a slam dunk given the looming recession I was talking about. So again, bad news is bad news if we get a recession. And that's kind of the current landscape that I see right now. Don't get me wrong. I'm not saying don't make a move in the real estate market right now and put a pause on it, because as you can see, most people are not. I'm just saying because of the things I just explained to you, you have to understand how this may affect you personally, because not everyone's subjected to a recession or losing a job. And this is why I still see a lot of demand right now outpacing the supply, especially in the entry-level freehold homes right now, despite the fact that there may be a looming recession coming. So this is kind of what I'm trying to explain to you and show you with all the data. And a lot of this stuff can affect the market in a negative way, but it doesn't affect everybody. And if you're very safe in your job, you're actually okay and could take advantage of this. So right now I am skeptically optimistic that we can hit the soft landing, but I'm preparing for the worst, but it's really outside of everyone's control, unfortunately. So I'll continue monitoring the macro and report back to you, but the latest update is that the update is not what most people are hoping for. And hopefully that gives an idea of some clarity on what's happening in the macro economy right now that may apply into, will likely apply to real estate market. And if you do want to talk about your real estate plans this year after watching this video and seeing some of the macro data I'm showing you, you can book a call with me using the link that's on the screen. It's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one or this one? You know what? Just watch them both.